If you just don't look at the last 9 months and you look at the last 3 years, Bitcoin and gold have exactly the same return. If you back up 5 years, Bitcoin's ahead. Back up 7, 9, they're the same. So why is that? Because they're the same thing. An ounce of gold is an ounce of gold, 1 Bitcoin is 1 Bitcoin. They're the same. What matters is the fluctuation of the fiat that you buy it with. Price is a liar. The price of any asset doesn't matter, and it has nothing to do with value. All the price that you or I see anywhere on any asset is just what the last 2 people agreed to trade a small amount, but the futures are optimistic. We always think the price is going to go up. So you sell it here and you roll down, right? And by the end of the month, then you have to redo it. And that's why at the end of every options expiration period, you see this massive change in pricing and supply and demand.
Mark Yusko begins with a deceptively simple question about the nature of risk in modern investing. For decades, traditional portfolio theory has revolved around diversification, combining different asset classes to reduce volatility while maintaining attractive returns. Investors start with cash, add bonds, introduce equities, and eventually incorporate alternative investments like private equity, venture capital, and hedge funds. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
We have this problem with cash. So we diversify into bonds and our portfolio gets less risky. No, that's not. Yes, it is, right? Because the volatility, yes, bonds are higher volatility than cash, but they're uncorrelated. They move differently because they're based on other things. So then I have cash and bonds and I add stocks. My portfolio risk goes down, not up. Like, no, that can't be. Well, it is. So then you add alternative investments, private equity, venture capital, hedge funds. Your portfolio efficiency, your Sharpe ratio, your return per unit of risk goes up. Okay, this thing Bitcoin comes along. Now, if you add 1% Bitcoin, not even a lot, 1% to a portfolio, your return per unit of risk goes up about 20%.
Wow.
Make 200 basis points compounded per year. Now, and I'm even excluding the first 4 years. To me, the first 4 years don't really count from kind of 2009, 2013, because it was sub a penny and it was tiny and you couldn't put any real money in it. But starting in 2013, you could put real money in. Even using that data, you get wildly accretive results. So people are finally given in to this idea. And those are people who want to own it forever as a diversifier for the portfolio. But they're going to buy 0.5%, 1%, 2%. Okay, great. Well, what we all hope is that other big institutions that have more money than individuals will do the same thing. Harvard, a few others have. Okay, that's good. That's all good. So then what's happening? Well, again, those buyers are doing exactly what you described, right? The key question, why isn't the price reflecting this step function increase in demand for spot? Well, it is, because if you look at the history, right, we make higher highs and higher lows. It takes a while and there's cyclicality to it, but we do make higher highs and higher lows. So that's an accumulation pattern over time. Well, what about sovereign wealth? What about the strategic Bitcoin reserve? We didn't get that, okay? So instead, we got the Genius Act, which is not as good as people think, and the Clarity Act, in its current form, bad, like super bad, like CBDC bad. So let's not have that. Brian, public enemy number one, I'm rooting for you. Bitcoin is fundamentally the future of money. Okay, now what does that mean? Well, money, this is an interesting point, right? Money is an asset that exists in the absence of a liability. Okay, what is that? Well, it happens to be gold, silver to a lesser extent, platinum, other rare, basically it has to be a scarce asset that cannot be created out of thin air and isn't backed by debt. And it's the old JP Morgan quote, right? Gold is money, everything else is credit. What we think of as money, dollars, yen, euros, whatever, are currencies. They're not money, they're currencies. They sit on top of money, and they are backed by debt, government debt. It's not bad or evil. In fact, I'm one of the few. I think fractional reserve banking is like the greatest invention of mankind. I mean, fire's up there and a few other things, but without fractional reserve banking, we all live in mud huts. I mean, it's what creates growth, because if the money just sits in a room and we all stare at it, it doesn't do any good. And that's why, the Portuguese monks, the Knights Templar, believe it or not, the original Illuminati, right? They figured it out. Some of their guys didn't come back, so they had all this gold in their little vaults. And they're like, we could lend that gold to someone else to go do another thing, and they pay us interest on it. And the next thing you know, the Medicis created banking, and here we are. So that idea is really important. And so for people who look at it as the money layer, those people aren't buying it yet. Central banks, governments, mostly central banks, because gold, everyone, you can have, gold coins or a few gold bars or whatever, right? That's your hedge against, total dystopian nightmare. And there's the stories that the people got out of the, Holocaust with their gold earrings or whatever. So that stuff is real. And that's because gold for 5,000 years has been a perfect store of value. But Bitcoin is better because let's say I had a bar of gold. Let's say I had that. I'm not strong enough to break it. And even if I could break it, I couldn't stuff it in the computer and send you a piece of it. But with a couple taps, I can send you Bitcoin, because all the Bitcoin in the world fits right here. If you just don't look at the last 9 months and you look at the last 3 years, Bitcoin and gold have exactly the same return. If you back up 5 years, Bitcoin's ahead. Back up 7, 9, they're the same. So why is that? Because they're the same thing. An ounce of gold is an ounce of gold, 1 Bitcoin is 1 Bitcoin. They're the same. What matters is the fluctuation of the fiat that you buy it with. But gold went up and Bitcoin went down. Yeah. And in 21 to 23, Bitcoin went up and gold was flat. So what happens is the spoofing, right? They were on gold for 2 years and they lost control. They were on silver for 5 years. I mean, silver was like, $20, $30 for 5 years. And then boom, they just lost control. And arguably, JP Morgan, there was a rumor they were bankrupt, right? Because they were 2 times short all the world's silver. They got caught short gold, which is why the GLD got introduced. So this happens. And now all the trade is on the short Bitcoin side. And there was a reason they attacked gold. I told you, right? They didn't want gold to go up because that tells the masses that they're being stolen from. You got to zoom out, first of all. Second of all, the correlation of any store of value to each other is going to be episodic because of this futures market. But over long terms, they're going to be very highly correlated. And that actually does show up in the data.
For thousands of years, gold served this role. It was scarce, durable, divisible, and widely recognized as valuable. These characteristics allowed it to function as a reliable store of wealth across cultures and centuries. However, Bitcoin introduces several advantages over physical commodities.
2009 to 2015, first they ignored you. No one cared about Bitcoin. Like, no one. I mean, a few people, but the average person couldn't even spell it, didn't know what it was. And like, yeah, nerds and geeks playing with their magic internet money, whatever. From 16 to 21, then they laugh at you. So now the nerds and geeks were real, and some of them were getting rich and doing fun stuff, but it's just still a bunch of nerds and geeks playing with magic internet money. Okay. Well, from 22, I think till 27, 28, That's the then they fight you phase. So we're right square in the middle of that. And it's everything from regulatory capture, which is what they're trying to do with regulations now. And we should be nervous about that and fight against it. Then you've got, the spoofing and the financialization. And you've also got the FUD wars. I mean, it's amazing how they just keep recycling the same crazy stories over and over again. And it's like, we've settled that. And I guess the thing that bothers me most, right, is, look, I'm not a techie. I'm not someone who really understands the code, and I'm not someone who grew up thinking that this was going to be my life's ambition. But, I'm a financial services guy, and I came to this and I studied it. And once I saw what it was, right? Once that I saw that it was a better form of money, you can't unsee that. Gold has been spoofed forever, right? And if you look at its pattern of movement from that $200, it was stuck at 200 because it was being spoofed with the futures. And then it breaks through, it has a short squeeze, it goes to 400. Then gets stuck at 400 in that flat zone that you talked about, and because it's being spoofed. And then it breaks through and it goes to 1,000. And then it was stuck at 2,000 for 2 years. And then boom, it breaks through and it goes in this parabolic short squeeze. And silver was another one. Silver went even worse than gold, right? It went like crazy parabolic. And then it crashed because they fined JP Morgan and a bunch of other guys $1 billion for spoofing the price. So what does that have to do with Bitcoin? So we just had, 13F release, and the 13F comes out and it was like, oh, look, Millennium has, a bunch of Bitcoin, and Jane Street has a bunch of Bitcoin. Like, no, they don't. No, they don't. They buy the ETF and they short the future against, but they don't have to report the short future position. So they are dollar neutral, and they are because they're just capturing the spread, right? The future price of an asset is higher than the current price, the spot price. Well, not necessarily. But the futures are optimistic. We always think the price is going to go up. So you sell it here and you roll down, right? And by the end of the month, then you have to redo it. And that's why at the end of every options expiration period, we see this massive change in pricing and supply and demand. So I do worry that this is going to be a bumpy summer. But eventually we'll get to spring and the investors will come back. Because today, fair value, it's dropped a little bit. It was 80-ish. And now, when cold weather comes and the miners shut off and a bunch of other things, the network value does drop a little bit. So I think the fair value now is in the 70s, but we're under that. And, yesterday we were way under that at 60. And then within, 24 hours, we're at 67. So that type of volatility, we're just going to have to deal with for a while. Price is a liar. Now, I stole that from John Burbank, so I will give him credit. The price of any asset doesn't matter, and it has nothing to do with value. Like, no, Mark, it's a reflection of the discounted stream of future cash flows. No, it is not. It is not. All the price that you or I see anywhere on any asset is just what the last two people agreed to trade a small amount of. I use Microsoft stock all the time. So Microsoft stock, $400, whatever. Okay. 100 shares traded. Bill Gates still owns $12 billion or something like that, or maybe it's more than that, of Microsoft stock. If he tried to sell 1 million shares, he would not get $400. If he tried to sell 1 billion shares, he would not get $400. It's just not going to happen. And the same thing's true with Bitcoin or any other asset. So price has nothing to do with value. It's just what people perceive the facilitation of a trade. So market cap's just a silly notion. And Bitcoin is funky in the sense that there's a whole bunch of Bitcoins of the 20 million that have been mined, 3, 4, 5, 6, whatever, some number, they're gone forever.
Yep.
So when we take the current price and multiply it by 20 million, that's not right. That's a mythical number that doesn't exist.
Mark Yusko's perspective ultimately reframes Bitcoin not as a speculative trade, but as part of a broader transformation in how society understands money and value. Within the traditional framework of portfolio construction, Bitcoin appears to offer extraordinary diversification benefits, improving returns even at small allocations.